The S&P 500 has been seeing huge declines year to date. We can see they are down over 14%, and this huge decline in the market has taken its toll on every single stock, and that includes what I think is one of the best companies in the world in Microsoft. We can see over the past month they are down nearly 9%, and year to date they are down nearly 18%. So in this video, we're going to be jumping into my stock valuation spreadsheet to see if we can find the intrinsic value of Microsoft and decide if it's a stock we should be buying. On this valuation spreadsheet, we have 4 different valuation models. We have Graham's valuation, a discounted cash flow model, a multiples valuation, and a dividend discount model, and all of these valuations will roll into our output tab. So let's go ahead and jump over to our stock screener. If you'd like to be able to download this spreadsheet, then you can head over to my Patreon page at the link in the description. So let's go ahead and come up here and plug in Microsoft stock ticker and hit enter. And we can see all this data is going to automatically be pulled. So we're currently looking at a 1,000 day change, but let's go ahead and zoom in a little bit. I'm going to type in 250, and we can see it is down a good bit from its recent all-time high. Now, if we come over here, we can see the moving averages. It's 20-day moving average, 50-day, and 200 moving day average are all down. If we come over here, we can see the dividend data. They're currently paying out $2.48 per share in their dividend. Their dividend yield is higher than it typically has been over the past few months because of the new lows it's seen. It currently has a dividend yield of 0.9%. The payout ratio is only sitting at 24.5%, so this is a very safe dividend. A couple of things we will note: the analyst target price is currently sitting at $364, so much higher than it's currently trading at. Institutional ownership is pretty high with this company sitting at 72%. All the business metrics are really strong. Now, Microsoft did just recently release their earnings. We can say they did beat their earnings across the board. And this is kind of something that's surprising due to the fact that a lot of tech companies have reported poor earnings over the past month. We can see they had $2.22 per share versus $2.19, revenue of $49.36 billion versus the estimated $49.05 billion. And something else worth noting, I think, here is Microsoft's revenue increased by 18% year over year. I think that is a really good sign for their business. Now, this is a company that takes up 19% of my current dividend portfolio, so I'm a huge believer in this company. But let's go ahead and jump into our valuation models. And the first valuation model we're going to look at is Graham's valuation. So let's go ahead and zoom in here. And this is a valuation model invented by Benjamin Graham, who was one of Warren Buffett's mentors, and he wrote the greatest investing book of all time, The Intelligent Investor. You can see here he laid out a formula to calculate the intrinsic value of a stock. So the first thing we need is our earnings per share, which we can see for Microsoft is currently sitting at $9.58. We're then going to take the price to earnings of a company with no growth and multiply it by a growth rate. Analysts are currently projecting a growth rate of about 17.5. I think I agree with that, so I'm going to keep that here. Then we're going to multiply all that by 4.4, which is the average yield of AAA corporate bonds. Once we have this number, we are then going to divide it by Y, which is the current yield of AAA corporate bonds, which is currently sitting at 4.28 at the time of this video. After we plug all this in, we can see the intrinsic value of Microsoft is sitting at $241 per share, which is below the current price of $274. Now, this is actually a really good example of how great of a factor the current yield of AAA corporate bonds has on this valuation model. So for example, if we jump over, we can look at the historical AAA corporate bonds over the past year. We can see over in January, it was sitting as low as 2.79. So if we plug that in right here and hit enter, we can see this would actually change the intrinsic value up to $370 per share. So you can see just how the sensitivity of the current yield of AAA corporate bonds can really have an effect on this valuation model. Current market conditions definitely play a role in Graham's valuation. But let's go ahead and jump over to our discounted cash flow model. And essentially for our discounted cash flow model, we want to project a growth rate for the future free cash flows of Microsoft. So what I've done is I've looked at the historical free cash flows for Microsoft and saw that they had an average growth rate of about 17.8%. I think that stays consistent with analyst growth rate estimates of about 17.5. So I'm projecting a 17.5% growth rate for the future free cash flows of the company, which you can see right here. I then use that same growth rate to project the terminal value, which is the sum of all the future free cash flows past the year 2030. I then put in a formula to find the present value of all of these future free cash flows and added them together, which we can see right here. I then added Microsoft's cash and cash equivalents and subtracted out their total debt, which gave me an equity value, which you can see right here. I then took the equity value and divided by the number of shares outstanding, and you can see this gave me a discounted cash flow price per share of $352, which is far above the current price. Now let's take a look at our multiples valuation model. The idea behind our multiples valuation model is we want to see how the market is valuing companies that are similar to Microsoft using a price to earnings multiple. So what I've done is I've taken companies like Apple, Amazon, Google, I took their stock price and divided it by their earnings per share, which gives me their price to earnings multiple. I then took the average price to earnings multiple and multiplied it by Microsoft's earnings per share, and this gave me an intrinsic value with the multiples valuation model of $325 per share. Now it's also important to understand, since we're currently looking at the multiples valuation during a huge market downturn, these companies are going to have lower price to earnings multiples, which is going to create a lower intrinsic value for Microsoft, so that's something to keep in mind. Now let's look at our dividend discount model. And this is a valuation model that I absolutely love for Microsoft. They have phenomenal dividend growth and a very low payout ratio. So essentially the idea behind the dividend discount model is we can find how much a stock is worth based on how much they pay out in dividends and how fast that dividend is growing. So what I've done is I've plugged in how much they've been paying out quarterly each year in dividends, which allowed me to see how much they pay out yearly in dividends. Once I have that, I can see how much they are growing this dividend year over year. So we can see 2017 to 2018, 9.52% growth, to 2019, almost 11% growth, almost 9.8% growth, and then almost 11% growth. So over the past few years, the dividend has an average growth rate of about 10.23%. So that is phenomenal dividend growth for a company like Microsoft. So all I need to do now is project the growth rate for these dividends in the future and apply a discount rate. So while a 10% growth rate is really great for this company, I think they're going to have more of about a 7.75% dividend growth rate in the future. That's still a really high growth rate, but the 10% likely won't stay forever. I then projected a discount rate of about 8.5%. And this gave us an intrinsic value of $356 per share. Now again, we want to jump back over to the stock screener. Anytime we have a really high growth rate with our dividend discount model, you want to look at the payout ratio, and we can see the payout ratio is currently sitting at 24.5%. So this is indeed a very safe dividend growth stock. Now let's go ahead and jump over to our output tab. And here on our output tab, we can see all four valuation models together. We have grams at 241, multiples at 325, discounted cash flow at 352, and dividend discount model at 356. So when we average all four of these together, we can see this gives us an intrinsic value of $318 per share. Now the current price of this company is currently sitting at $274 per share, which is a difference of about 14%. Now, as a value dividend investor, I always believe in applying a margin of safety into my investments. So typically, I'm going to apply anywhere between a 20 and 30% margin of safety. So I'm going to go ahead and do 20 in this scenario. So when I hit enter, you can see this gives us an acceptable buy price of $255, and it tells us this is not a stock we should be buying. This is actually one of the rare occasions for me where I think Microsoft is still a buy despite what our margin of safety is telling us to buy at $255 per share. And one of the reasons behind this is because you can see Graham's valuation is significantly lower than these other four valuation models. Now, Graham's valuation is still important to use when trying to find the intrinsic value of a stock, but I think when we look at a company like Microsoft, this is a company that recently reported their earnings like we just looked at earlier. And they had really strong earnings despite the recent market downturn. So while we look at Graham's valuation, we know they're much lower because of the current yield of AAA corporate bonds, which like we looked at earlier, really drives the intrinsic value of Graham's valuation. If we come over here and actually take out Graham's valuation in this situation, you can see it gives us an intrinsic value of $344 per share, which now gives us a buy price. I'm very bullish on Microsoft. Like I said earlier, it actually takes up 19% of my current dividend portfolio, but I suggest you always do your own research when looking into stocks and make your very own investment decisions. If you'd like to be able to download this spreadsheet, then you can head over to my Patreon page at the link in the description. There you can also gain access to a private Discord. If you'd like to follow along on my dividend investing journey, then you can follow me on Twitter. So with that being said, thank you guys so much for watching this video, and please don't forget to like and subscribe to the channel.